on working capital management. I am Aseem Kumar, and this is the fifth session we are presenting today on this topic. Friends, till 13th of June, we have covered Block 1, Block 2, and Block 3, where in Block 3 we have covered 3 units of it, consisting of theories and approaches, payables management, bank credit, principles and practice. And we are going to cover the 4th unit today, that is unit number 11. Out of Block 2 on management of current assets, we have finished management of receivables, management of cash, management of marketable securities, and on management of inventory. In the first session, we had completed the conceptual framework, operating environment of working capital in the subsequent part, and on the determination of working capital. Friends, today we are going to cover 1 unit of Block 3 and the other unit of Block 4. In Block 3, we are going to cover other sources of short-term finance, and in Block 4, the working capital management in SMEs. In the financing of working capital, we are going to cover the last unit of this block. Unit 11, other sources of short-term finance. Friends, whenever we are just talking about the trade credit and commercial bank credit, have been 2 important sources of funds for financing working capital. Needs of the companies in India, apart from the long-term source like equity shares. However, more stringent credit policies followed by the banks, tightening financial discipline imposed by them, and their higher cost led the companies to go for the new and innovative sources of finance. That means for facing this challenge, now the new innovative sources of finance have emerged. What are those? As the new equities market has remained in a subdued condition and investor interest in the equities has almost vanished during the recent years, corporates have raised larger resources through debt instrument. Now, here it is the important breakthrough. We are now raising the funds through debt instruments. Some of them being for as short a period of 18 months. The situation has turned buoyant for corporates during the 21st century for any type of finance. Friends, this particular para indicates that now there is a paradigm shift of the generating of resources from the market, where equities have come out to be a very, 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 very dim response from the investors. Now these short-term investors are coming up as a new boon in the market. Raising short-term and medium-term debt by inviting and accepting deposits from the investing public has become an established practice. So this is the need of the hour, and accordingly the practices also have been changed accordingly, with a large number of companies both in private and public sectors. And this is the outcome of the process of disintermediation that is taking place in the Indian economy. Similarly, issuance of commercial paper by high net worth corporates enables them to raise short-term funds directly from the investors at cheaper rates as compared to bank credit. Because the stringent conditions of the bankers, their high cost of the generation of these resources, the corporates have taken all those resources generation and in their hands, and thereby they are raising these resources at a cheaper cost than the bank credit. In practice, however, commercial banks have been the major investors in the commercial paper in India. Now, this is again now the turning point. There are people who are coming up as investors. Who are they? They are the commercial banks. They are the people who were giving the credit to these corporates. They are the people who are just say giving this credit on the other hand, implying thereby that the bank credit flows from corporate sector through the route of CPs, intercorporate loans, and investment enables the cash-rich corporation to lend their surplus resources to those who need them for their working capital purposes. Now there is a paradigm shift. It is those who have or those who don't. The amount which they have, they are willing to invest in the other companies, and those who don't have, they are inviting these deposits. Further, the factoring of receivables is a relatively new innovation which enables the corporates to convert their receivables into liquidity within a short period of time. The factoring of receivables, there is someone who will just play the role of a factor and who would be just giving you a sort of facility immediately, instantly, with the responsibility that they will take care of the collection of money on your behalf. So let us just look at what are those generation of resources we have for the short term and medium term. Public deposits. Public deposits are unsecured deposit accepted by companies for specified period at a specific rate of interest. Now, specific periods, specific rate of interest. These deposits have acquired prominence as source of finance for the companies as it is more convenient and cheaper to mobilize short-term finance through such deposits. So, because it is cheaper, it is reasonably coming out to be with a shorter possible time. Therefore, now this is coming out to be a sort of need of the hour. So the public deposit provide a fine example of disintermediation as the borrower directly accept the deposits from the lenders, of course with the help of brokers. Somewhere or the brokers are also coming into. However, we have to just look at these are the shortest possible things you are just doing it. In India, acceptance of deposit from the public is regulated by sections 58A and 58B of the Companies Act 1956 and the Companies Rules 1975. The above sections were inserted in the Companies Act in 1974 with the objective to safeguard the interest of the depositor. The regulatory framework in this regard is contained in the Company Act and the rules. Now the legal position has changed with the passage of New Companies Act 2013. The position was revamped to a greater extent. New sections in the Companies Act that pertain to deposits are 73 to 76. Earlier it was 58A and 58B. But now it is 73 to 76, corresponding to sections 58A and 58B. Many of the deposits which were considered as such in the previous situation are not accepted as deposits now. There is a paradigm shift. There have been stringent restrictions in accepting deposit from the public now. Of course, over a period of time, because there were certain anomalies had crept in, Therefore, there are certain stricter, stringent restrictions in accepting deposit from the public now through these sections of 73 to 76. Following are the pertinent aspect relating to this issue. No company shall invite or accept deposit from public unless the company meets a specified criteria. Now that meeting that criteria is a paramount thing. As at present, a public company having a net worth of rupees 100 crore or turnover of not less than 500 crore will only be eligible to accept deposit from public. Now, why there is a limit of 100 crore and 500 crore turnover? Because when you are accepting the funds from some people, definitely you own that responsibility. So you must be sound enough at least to take care of those deposits and to return them in time. The public company shall obtain credit rating every year from a rating agency and publish it properly. Why? Because the credit rating is just giving you the idea that at what level this particular company is, whether it is safe to invest with them, whether they are good paymaster, whether they are refunding it in time, both interest and the principal amount. If so, people are keen to invest. It shall create a charge on the assets equal to that amount of issue. Why their charge? Because the financial soundness is okay. Still, there are certain issues where these public deposits may have the misuses. So you should have a charge on the assets equal to the amount of issue. All other companies can accept deposit only from their members. Okay, from their members. The Ministry of Corporate Affairs, through the notification dated 31/3/2014, issued Companies Acceptance of Rules 2014, incorporating rules on the following. What? The terms and condition of acceptance of deposit by companies. 2014 once again. Form and particular of advertisement or circulars. How you have to advertise. Manner and extent of deposit insurance. How you are just going to ensure that the extent of deposit insurance. Creation of security. How you make it a secured deposit in your organization. Appointment of trustee for depositors and their duties. How that particular amount, those deposits, would be taken care of through a trustee. Meeting of depositors. This is again a sort of imposition. Form of application for deposits. And maintenance of liquid asset and creation of deposits. Repayment reserve account. This is something, repayment reserve account, where you are just making a sort of accounting treatment of these deposits. The safety accounting treatment. Register of deposits. In the register of deposits, we are just giving the information about the depositors. Let us just look at the first, maintenance of liquid assets. How do you just say keep maintenance of liquid asset? That means your cash and other short-term deposits. Each company accepting public deposit is required to deposit or invest before 30th April of each year an amount which shall not be less than 15% of the amount of its deposit, which will mature during the next financial year ending 31st March in any one or more of the following. In a current or other deposit with any scheduled bank, free from charge or lien. This you have to deposit. In unencumbered securities of central and state governments. In unencumbered securities in which trust funds may be invested under the Indian Trust Act 1882. In unencumbered bonds issued by Housing Development Finance Corporation Limited. So it could be one or it could be more out of these four. Rate of interest and brokerage. The rules prescribe the maximum rate of interest payable on such deposit. At present, companies are allowed to pay interest not exceeding 15% per annum at rate which shall not be shorter than monthly rests. Companies are permitted to pay brokerage to any broker at the rate of 1% of the deposit for a period of up to 1 year and 1.5% for a period more than 1 year. But up to 2 years and 2% for a period exceeding 2 years, such payment shall be on one-time basis. How do you advertise? Every company intending to invite or accept deposit from the public must issue an advertisement for that purpose in a leading English newspaper or in one vernacular newspaper circulating in the state in which the registered office of the company is situated. The advertisement must be issued on the authority and in the name of the board of directors of the company. The advertisement must contain the conditions subject to which deposits shall be accepted by the company and the date on which the board of directors has approved the text of the advertisement. When you are issuing the advertisement in the name of the board of directors, definitely their approval also should have the mention in the advertisement. Procedure for accepting deposits. Every company intending to accept public deposits is required to supply to the investors the forms which shall be accompanied by a statement by the company containing all the particulars specified for advertisements. The application must also contain a declaration by the depositor stating that the amount is not being deposited out of the funds acquired by him by borrowing or accepting deposits from any other person. Okay. Register of deposits. Every company accepting deposits is required to keep a registered office, one or more registers in which the following particulars about each deposit are to be entered. Name and address of the depositor, date and amount of each deposit, duration of the deposit and date on which each deposit is repayable, rate of interest, date or dates on which payment of interest will be made, any other particulars relating to the deposit. These registers shall be preserved by the company in good order for a period of not less than 8 years from the end of the financial year in which the latest entry is made in the register. So a time limit for keeping that financial records. Repayment of deposits. Now, when you accept the deposit, you are supposed to repay them. Deposits are accepted by companies for specified periods, say 12 months, 18 months, 24 months. So once it is 12 months or less than 12 months, it is short term. Once it is just crossing 1 year to 2 years, 3 years, then it becomes medium term deposits. And there we are intending to. Companies prescribe different rate of interest for deposit for different periods. If so, other terms and conditions are also prescribed by the companies and interest is paid at the stipulated rate at the time of maturity of the deposit. But if the depositor desires repayment of the deposit before the period stipulated, then what happens? Companies are permitted to do so, but the interest is to be paid at a lower rate. At a lower rate, because you are intending to get your deposits back earlier. The same thing, the banks are also applying for their depositors. Like that only, the companies also they have the binding or a rule to follow. Return of deposits. Every company accepting deposits is required to file with the registrar every year before 30th June a return in the prescribed form and giving information as on 31st March of the year. It should be duly certified by the auditor of the company. A copy of the same shall also be filed with the Reserve Bank of India. Like income tax return, like property return, this is the return of deposit. Also, you are supposed to just say submit with the registrar and with the RBI because you are accepting this like a banker. Penalties. The rules 2014 also provided machinery for repayment of deposits on maturity and also prescribes penalties for defaulting companies. If a company fails to repay any deposit or part thereof in accordance with the terms and conditions of such deposit, the company law board may, if it is satisfied, direct the company. Number two, they direct the company to make repayment of such deposit forthwith or within such time or subject to such condition as may be specified in this order. So the order would be issued, that would be giving the time and the deposit amount. But if any company contravenes these rules, the company and every officer of the company who is in default shall be punishable with a fine which may extend to 5,000 rupees and the contravention continuing, the company and every officer shall be liable with a further fine which may extend to rupees 500 per day. Now friends, when we are accepting the deposit, we have to pay them interest, and when there is a sort of payment of interest, the section 194A of the Income Tax 1961 invokes. The company accepting public deposits are required to deduct income tax at source at 10% if the aggregate interest paid and or credited during the financial year exceeds rupees 40,000. Friends, apart from public deposit, we are having commercial papers is one such other source of raising short-term finance. It is by the high-rated corporate borrowers for working capital purposes. A commercial paper at the same time provides an opportunity to cash rich investors to park their short-term funds. The Reserve Bank of India permitted companies to issue commercial paper in 1989 and issued guidelines entitled Non-Banking Companies Acceptance of Deposits Through Commercial Paper. Directions 1989. This was the title. Why they have issued these guidelines? To regulate the issuance of CPs, commercial papers. The guidelines have significantly relaxed and modified from time to time. The salient feature of these guidelines are as follows. Eligibility to issue commercial papers. Companies except the banking companies which fulfill the following requirement are permitted to issue commercial papers in the money market. The minimum tangible net worth of the company is rupees 4 crore as per the latest audited balance sheet. The company has a fund-based working capital limits of not less than 4 crores. So tangible net worth, we are talking about the net worth and the 4 crore as working capital limits also. The shares of the company are listed in one or more stock exchanges. Closely held companies whose shares are not listed on any stock exchange are also permitted to issue commercial papers provided all other conditions are fulfilled. The issues where the shares are listed are benefited, but those who are not listed are not debarred. Subject to certain terms conditions, they are also allowed to accept the deposits. The company has obtained minimum credit rating from a credit rating agency, CP2, from Credit Rating Information Services of India Limited, A2 of Investment Information and Credit Rating Agency of PR2, from Credit Analysis and Research. Terms of commercial papers. The commercial paper may be issued by the companies on the following terms and conditions. One, the minimum period of maturity should be 15 days. It was reduced from 30 days. Effective May 25, 1998. And the maximum period less than 1 year. Right? The minimum amount for which a CP is to be issued to a single investor in the primary market should be rupees 25 lakh or thereafter in multiple of 5 lakh. So the first single investor is 25 lakh and thereafter it is the multiple of 5 lakh. Commercial papers are to be issued in the form of issuance, promissory notes which are freely transferable by endorsement and delivery. So all those deposits could be exchanged by those people and they can get the money from their authorized people if they need funds after investing in your company. So it is transferable by endorsement and delivery. Commercial papers are to be issued at a discount to face value. The rate of discount is freely determined by the issuing company and investors. So the quantum of discount is according to their financial health and the kind of product they are dealing with, the kind of goodwill they have. The issuing company shall bear the dealer's fee, rating agency fee, and other charges. Stamp duty shall also be applicable on CP's commercial papers. Ceiling on the amount of issue of commercial paper. The amount for which the company issue commercial paper is to be carved out of the fund based on working capital limit enjoyed by the company with its banker. The maximum limit that can be raised through issue of commercial paper is equal to 100% of the funds raised based working capital limit. So the working capital limit was 4 crore and 100% of the fund based working capital limit. The latter is reduced pro tanto on the issuance of commercial papers by the company. Effective October 19, 1996, the amount of commercial paper is permitted to be adjusted out of the loans or cash credit or both as per the arrangement between the issuer of commercial paper and the concerned bank. Standby facility withdrawn. As stated earlier, the amount of commercial paper is carved out of the borrower's working capital limits. Till October 1994, commercial banks were permitted to provide standby facility to the issuer of commercial papers. It ensured the borrowers to draw on their cash limit in case there were no rollover of commercial paper. Thus, the repayment of commercial paper was ensured automatically. However, in October 1994, Reserve Bank of India prohibited the banks to grant such standby facility. Procedure for issuing commercial paper. The company which intends to issue commercial paper should submit an application in the prescribed form to the bankers or lender of the consortium of banks together with a certificate form and approved credit rating agency. The rating should not be more than 2 months old. The banker will scrutinize the proposal. If it finds the proposal satisfying all eligibility criteria and condition, shall take the proposal on record. Thereafter, the company will make arrangement for privately placing the issue within a period of 2 weeks. And then within 3 weeks of the completion of the issue, the company shall advise the Reserve Bank through its bankers the amount actually raised through commercial papers. The investors shall pay the discounted value of the commercial paper through a check to the amount to the account of issuing company with the banker. Thereafter, the fund based on working capital limit of the company will be reduced correspondingly. So banker is just coming out to be one of the regulator in this case. Friends, apart from having public deposit and corporate commercial papers, we are having intercorporate loans also. Like we too are the business people. If I have the surplus funds, I can lend it to my friends or to the other counterparts. And if they have the surplus sometime and I need money, I can also ask them to lend that money to me. So short-term finance for working capital requirements of a company may be raised through accepting intercorporate loans or deposits. Some companies which may have surplus idle cash due to seasonal nature of their operation or otherwise would like to lend such resources for such period when they are not needed by them. On the other hand, some other companies face financial stringency and need cash resources to meet their immediate liquid assets. The former lend their surplus resources to the latter through brokers who charge for their services. Bonds and debentures. These are not the short-term, say, raising funds. These are normally medium and long-term funds, which we are raising through bonds and debentures. So bonds and debentures are another form of raising debt for augmenting funds for long-term purposes as well as for working capital. You may raise these funds for your working capital, but it would be for long term. It has gained popularity during the recent years because of its depressed condition in the new equities. Market and the permission given to the bank to invest their funds in such bonds and debentures. Because in the equity shares, there are certain restrictions, but in the bonds and debentures, you can invest because it is for the short term. It is not for long term or for lifetime. These debentures may be fully convertible. It could be fully converted after a specified time, partly convertible, or non-convertible into equity shares. The salient points of the guidelines issued by Securities and Exchange Board of India (SEBI) in this regard as follows. Issue of fully convertible debentures having a conversion period more than 36 months will not be permissible unless conversion is made optional with put or call option. These are the conditions. Compulsory credit rating is required if conversion or fully convertible debentures is made after 18 months. If the issue size is above 1,000 crore, 2 ratings are necessary because of the amount limit. Premium amount on conversion and the time of conversion in stages, if any, shall be predetermined and stated in the prospectus. And the rate of interest shall be freely determined by the issuer. Any rate of interest they can issue looking at the financial health of theirs or the market conditions. Companies Issuing debentures with maturity up to 18 months are not required to appoint debenture trustees, but or to create debenture redemption reserve. In other cases, the name of debenture trustees must be stated in their prospectus, where it is above 18 months. The trust deed must be executed within 6 months of the closure of the issue. Any conversion in part or whole of the debentures will be optional at the hands of the debenture holders. Definitely those who are the investors. If the conversion takes place at or after 18 months from the date of allotment, but before 36 months, in case non-convertible debenture and partly convertible debenture, credit rating is compulsory. The premium amount at the time of conversion of partly convertible debenture shall be predetermined and stated in the prospectus. As we stated earlier, it must also state the redemption of the debenture amount, period of maturity, yield on the redemption for non-convertible, partly convertible debenture. The discount on non-convertible portion of partly convertible debentures in case they are traded, the procedure for their purchase on spot trading basis must be disclosed in the prospectus itself. Factoring of response, say receivables, once you are just through with all those possible things, there are certain factors like the brokers or the commission agents we have. They are the agencies who are receiving these receivables. Is the another source of raising working capital by a business entity. Factoring is an agreement under which the receivables arising of the sale of goods, services are sold by a firm to the factor, intermediary. The factor thereafter becomes responsible for collection of those receivables. In case of credit sales, the purchaser promises to pay the sale proceeds after a period of time. The seller has to wait for that period for realizing these claims from the buyer. So the cash cycle is thus prolonged and he needs larger working capital. So the factor of receivable is a device to sell the receivables to a factor who pays the whole or major amount of dues from the buyer immediately to the seller, and thereby reducing his cash cycle and the requirement of working capital. The factor realizes the amount from the buyer on the due date. With that, friends, we have completed block 3 and unit number 11. We are going to start with the block 4, working capital management issues and practices. And today we are going to cover working capital management in SMEs. The introduction says to define small and medium enterprises, academics and policymakers employed a range of criteria, including total work, relative size within the industries, number of employees, product value, yearly sales, or receipts. The benchmarks, on the other hand, differ significantly from country to country according to their financial health and market conditions. And classification can be based on a company's assets, several employees, or yearly sales. The nature of the unpredictability that SMEs encounter sets them apart from their larger counterparts. Smaller businesses are more likely to be reliant on a smaller number of consumers and have a restricted product selection. They are therefore more vulnerable to market instability. Small and medium enterprises versus large companies. Friends, there are several analysts who argued that SMEs have many advantages over their large-scale competitors because of their modern technologies which allow them to adjust more easily to market situations. They claim that SMEs can withstand unfavorable economic conditions because of their flexibility. They are more labor intensive than larger firms and therefore they have the relative low cost of capital associated with the job creation. Small firms are similar to large, well established corporations, but they have a lesser market presence. On the other hand, the larger firm must deal with a plethora of rules and regulations that they have imposed on themselves. As a small business owner, you will have a lot more leeway when it comes to making adjustment to business processes. Taking working capital management seriously and paying attention to the intricacies of how cash flows are handled can make the company more lucrative. This, when paired with the social networking, e-commerce, and data science, can be extremely beneficial to small businesses. A small or large businesses must be able to earn enough cash to meet its immediate obligation and hence continue to trade. The failure of small and medium businesses is caused by ineffective working capital decisions and insufficient accounting information that has been cited regularly. So many experts agree that the smaller they are, the less efficient they tend to be. Their management shall not be professional. They may be having a sort of less efficient staff. Of course, exceptions are there. Although little study has been done on the SME sector, articles on working capital management claim that the following distinctions in working capital management techniques exist. For short-term finance, there is a growing reliance on trade credit and bank overdrafts. Willing to extend overly generous credit in terms to win businesses, especially from large corporations. Weak control procedure and a lack of clear working capital management policy. Working capital management in SMEs unique characteristics. Any firm can have multiple sources of revenue and effective management of such resources can help the business run smoothly. While beginning, money and fixed assets are often long-term investment. An effective cash flow structure is essential for the day-to-day operations of any organization. In light of this, working capital becomes increasingly important for small business owners. Furthermore, many small businesses run their operations without keeping track of how their working capital is being used. But in reality, small business owners cannot afford to ignore working capital management process. Furthermore, many small businesses do not maintain accounting record for their operations. As a result, without proper accounting records and information, SMEs have a difficult time distinguishing between their working capital and earning. So what becomes the result? SMEs frequently fail a few years after they are founded. What the other results? The goal of working capital management is to keep the net capital at a level that maximizes the wealth of the firm's owners. Working capital management goals for SMEs. Friends, the basic goal of working capital management, whether small or large, is to maintain a level of working capital that maximizes the value of the firm's owners, shareholders. In addition, the following are some of the goals of working capital management. Working capital and the liquidity of the firm are inextricably linked. As a result, Good working capital management ensures that the company has enough cash on hand to meet its short term obligations and run its day to day operations. Further, there should be a link between the profitability and working capital as well. Because of the cost of financing, the firm's current assets, the amount of capital has an impact on its profitability and working capital. There are evidences that many SMEs are poor at managing their working capital, which has been highlighted as a primary reason for their high failure rate when compared to bigger enterprise. Working capital management. As previously stated, there is a link between the working capital investment, cash availability, and other cash uses and resources. If a company invests too much money in working capital, the quantity of money available for the other businesses need to be lowered because the equilibrium will not be there. Because it does not have enough cash to invest in the long-term assets that can provide higher return. This could have an impact on the future profits. Because when you invest in the fixed assets, it tends to give you the higher return. Capital issues, debts, or the sale of current assets, which are usually costly for the company, can be used to raise cash. The best strategy to fund the working capital required is to use the cash generated from operating activities. This will ensure that you have enough cash to pay your tax and dividend obligations. Friends, there are no fixed norms or criteria for calculating the company's working capital because it varies from time to time according to your deliverables. The assessment, the level of working capital, the company must evaluate a variety of elements. What are those? The amount of working capital required by a company is influenced not only by the company's internal characteristics, but also its economic, monetary, trading, and working capital regulations. Amongst the other various factors, the following are important ones. Nature of business. The type and size of working capital are influenced by the characteristics of the firm within the industry. For example, a retailing unit has a specific inventory, such as finished items. These are the things that were purchased on credit. However, the majority of the sale were made in cash. The stock level of the item is typically high, and some merchants have just-in-time relationships with suppliers, allowing them to lower the cost of inventory keeping. Raw material, work in progress, finished goods, and consumables are the four categories of inventories found in a manufacturing company. Keeping inventory costs a lot of money. Thus, these companies commonly buy and sell on credit. Manufacturing companies, on the other hand, typically have a high amount of trade receivables and trade credits from suppliers. So again, a kind of equilibrium between the trade receivables and trade credits. Working capital policy. Because less cash is tied up in current assets, a more aggressive working capital program will boost profitability. The risk will also rise if the likelihood of cash shortage or inventory shortage increases. Maintaining a greater cash position, possibly even investing in short-term securities, offering more generous credit terms to the consumers, and storing higher quantities of inventory are all connected with a conservative and more flexible working capital policy for a given level of turnover. This policy will result in lower risk but at the cost of lesser profitability. because you incur certain other cost when you intend to give the credit. Financing of working capital. A fair financing policy allocates short-term funds to fluctuating current assets and long-term funds to permanent current assets and non-current assets. The fund maturity correspond to the maturity of various types of assets. Long-term funds are used to finance non-current and permanent current assets in a conservative financing approach. The risk of conservative working capital is lower because you are already conservative movement adopting for, since there is less reliance on the short-term financing, but the higher cost of long-term funding reduces the profitability. Short-term funds are used to finance not only the fluctuating current assets, but also some permanent current assets under the aggressive financing policy. Now it is no more conservative, it is aggressive financial policy having some kind of risk factor as well. Optimization of working capital, the following are the various barriers to optimizing the working capital in small and medium enterprises. Customer and rivalry, fear of compromising relationships and revenue by pursuing customers for payment too aggressively. This is one such barrier also. There is a chance you will lose clients to the competition. Fear of drop in customer service if inventory levels are not kept high. Customers are granted payment discounts even if they don't pay on time. Longer payment terms are being offered to competition, due to competition. So this is such barrier you have in the long term. Suppliers. Concern about how suppliers will react and the potential of disruption to supply as a result of a unilateral move to extend payment terms. Negative media impact on the organization's reputation if payment terms are extended, especially for minor supplies. Indicate your financial health, control and accountability. The importance of cash is not reflected in individual or organizational performance measurements. Working capital is a complex topic with multiple functional areas to which no single person can be assigned authority. Advantages. Are there any advantages? We will be unable to run the firm on day-to-day basis if we restrict liquidity, because you have to run it on daily and time to time. Are the advantages long term? It can control working capital levels after fiscal year, but they quickly climb again. Overtrading in small and medium enterprise. Overtrading is one of the issue that many businesses, particularly small and medium-sized businesses, face. Overtrading occurs when a firm expands too quickly and does not have enough long-term funds to support the increasing asset level. Where a company's revenue expands, so does the quantity of working capital it has. In the absence of additional funding, the company may put pressure on its debtors and creditors correspondingly. This could indicate that the corporations is behind on payment to creditors, is putting pressure on the existing debtors to pay up sooner. Overtrading impact reduced. To mitigating the impact of overtrading, it is recommended that the company maintain its growth strategy and take steps to secure the appropriate long-term finance. The corporation can sell non-current assets for cash to finance working capital if they do not create enough income and are not crucial to the firm. The working capital policy should be reviewed to reduce trade receivables and inventory holding periods while simultaneously increasing trade payable periods without affecting the prices discounts agreed upon with suppliers. The company must reassess its growth strategy, and if it expands too quickly with insufficient financial resources, it may face financial difficulties. Determination of working capital in SME. Firm specific factors: firm age, firm size, firm leverage, financial leverage, and foreign sales. The owner specific factors are gender of manager, because the because of the assumption we have on the male, masculine, and feminine gender, education of the manager, and experience of the managers. But when we talk about the behavioral biases, according to the classical finance theories, individual and rational and make decisions. Individuals are rational and make decisions based on the predicted utility maximization. However, in real life situation where people are not completely logical, the truth does not match these expectations. It has been shown in the field of experimental psychology that humans generally depart from the classic rationality paradigm. Moods, emotions, personality traits, and other behavioral aspects influence their decision making. Effective working capital for SMEs. Many SMEs owners in reality run their business through trial and error. They frequently focus on the innovation and sales, but they are less strict when it comes out to financial management. Particularly working capital management, they believe that making money is the most important thing, but this is not always in the case. During the growth phase, they may run out of funds needed to fund operations, activities such as payroll, rent, and payable accounts. So, reduce an inventory. The control on inventory has a substantial positive impact on the working capital. The company can negotiate with its supplier to have goods stocked in the warehouse but not paid for until the company sells them. This policy, as well as careful planning and controlling stock levels to accommodate demand peaks and troughs, decreases cost while increasing revenue. More specifically, the following lines show how organization can reduce inventory across the value chain. Enhance forecast accuracy and demand planning, improve delivery and logistics concepts, optimize production processes, variance management. Second part is secure good credit terms. Credit terms must be handled properly by the business entity with its consumers, suppliers. Before extending credit, sales and marketing department must identify and thoroughly assess the customer's position. This ensures the debt are paid on time so that the customer relationships and businesses are not harmed. Furthermore, the company must carefully negotiate payment terms with its suppliers to ensure that it receives the largest payment term possible without jeopardizing its ties with them. We can avoidance of early payments, and we can renegotiate also the payment conditions. And the final thing is back-to-back agreement matching to the due date, receivables and payment accounts can assist organization to avoid excessive supplier pre-financing and maintaining a positive cash balance. Strategic planning for working capital performance. We will not know exactly what happened after the COVID-19 disaster, but we do know that similar trends are now guiding divestment strategy. Lenders and investors are more cautious about lending money to tiny businesses since the risks are higher than with established large businesses. Small businesses may face higher borrowing rates as a result of this, which will limit their ability to recruit outside investors and assess capital markets, forcing them to rely more on owner financing or trade credit. As a result, it is critical for small and medium businesses to effectively manage their cash conversion cycle. With that, friends, we have finished our fifth presentation on the working capital management. We will have our sixth and the last session next time on the remaining unit of this course. Thank you. Namaskar.